Good morning. Welcome to Trading Hour. It's a Tuesday morning. I'm Reema Tendulkar. With me is Sonal Boothra, and staring at mild cuts on the Nifty and the Sensex. The Nifty is below 25,800, down about 40 points. But at the session's high, it was more than 25,900 on the Nifty. Mid-caps too are seeing a mild, red tick, though the advanced decline ratio is in favor of the gaining side. IT is holding up well today.
It is, and there's a note coming in, so we'll discuss that as well in greater detail. But the good part is it's a truncated week, Reema. You know, tomorrow is a holiday. It's coming after a long time.
Yeah.
So looking forward to that. But of course, we've seen some fall yesterday as well. That continues in some way today. We have seen a recovery from the lows again that has been sold into. There is some resistance at 26,250 to 26,475. That continues to be an important level. We've broken over from the support of 25,849. So where we go next will be very important to watch out for. As Reema said, Nifty IT is doing well. Bank Nifty is in the green, so that's slightly outperforming the benchmarks right now. We have the small cap index also, which is in focus right now. So while the mid caps are down 76 points, we do have the small cap index, which is in the green. So that's the kind of markets where we are in, where mid caps are not doing so well, but small caps are. So a lot of management commentary that we have gotten through the course of the day. So let's just do that. Let's begin the show with a CNBC TV18 exclusive. MD and CEO of Tech Mahindra Bank, Ashok Vaswani, says they are engaging with RBI almost every week in an effort to lift restriction. He also spoke in detail on the impact of the RBI restrictions on customer additions and a lot more. Listen in.
I think that is the big overhang today as far as the Tech Mahindra Bank story is concerned, with the RBI imposing restrictions on account of deficiencies in the digital and IT infrastructure, not allowing you to onboard mobile as well as digital customers, as well as putting restrictions on your credit card business. Now, if you can share with us details on what you've been specifically able to do to demonstrate to the Reserve Bank that you are adequately or appropriately addressing those deficiencies, and where do you believe that you stand? I mean, there is of course an external audit that's also been sought, but where do you believe you stand in the remedial measures?
So we've taken this as an opportunity to really say how we'll really leapfrog and make our systems really resilient and relevant for the day, for the days to come. So I think we've made very, very good progress. Obviously, we've been in continuous touch with the RBI, sometimes even every week, updating them, getting their guidance, making sure we're on the right path. And I think we've made tremendous amounts of progress, and we'll continue to do it. Obviously the RBI is exceedingly important, but the customer, I've got to get it right by the customer.
Yeah.
I got to stay resilient for the customer. I need the best customer experience for the customer. And, RBI has told me, you got to do it. So,
and I understand that some of this is confidential, some of this is of course up to the regulator to speak about as well. But from your perspective, and you said that you're engaging with the RBI sometimes even on a weekly basis, again, for the benefit of our viewers who are watching, what are the steps? If you can give us some specifics, the steps that you have taken, what has that meant in terms of incremental investments, for instance, as well? What has that meant in terms of big changes on the IT infrastructure side to address some of the deficiencies that have been pointed out? And whether there's been an acknowledgement by the Reserve Bank in any form or fashion, formally or informally, on any of those measures?
So, actually, the process started about 2 years ago when we started ramping up our investments in technology. And we spend roughly 10% of our entire OPEX on technology. So that adds up to a very significant sum. And we've been kind of growing that to about 11%. Since the order, we've doubled up on resources. We've used, consultants and stuff like that. And we also, I think, went on record to say that the cost of the order would be something to the extent of about 450 crores on an annualized basis. And pretty much that number seems to be correct even now. But like I said, we've made tremendous amounts of progress. If you look at downtimes, they're down significantly. Customer experience has improved quite significantly. And when we come out of the gate, I think we'll come out of the gate exceedingly strong, both in terms of new products, but new customer experiences, much higher level of resilience, and really deliver great products and services for our customers.
You know, I also want to understand from you what the implications or the impact is likely to be as far as customer addition is concerned. You know, for instance, FY23, 8.5 million customers, 8.8 million in FY24. A lion's share comes on board via the digital route. So what is the likely impact till these restrictions are lifted? And even post the restrictions being lifted, how confident do you feel of being able to better these numbers?
So that's actually a Shirin, very, very interesting question. As you correctly said, we get a lot of our customers digitally, right? Now, what have we done since the RBI has asked us not to onboard digitally? We've changed our processes and changed it from digital only to assisted kind of journeys, where a human being assists the customer to do the journey and complete the journey. So obviously we can't do as much as we were doing digitally, but we are running at roughly 30-35% of what we were doing pre the order. Once this is lifted, I'm very confident that we'll come back stronger, because even now, while the order exists, the amount of traffic we are seeing on our websites asking for digital products, obviously we can't fulfill, but the demand still exists. So when we get out, I'm hoping we come out even stronger. And we've used this period not only to improve our technology, but, for example, use it to create new journeys on the mobile app, which will allow a customer, instead of taking one product, to take 4 products. So when we come out, we should come out with a much, much stronger proposition and a far more fulfilling proposition for the customer and a profitable relationship for the bank.
Let me move now to talk about the banking environment in specific and the big concern for banks on the deposit side. And I want to understand from you how you're looking at this, whether you see this more as a structural issue and how you intend to mitigate what we're seeing on the deposit side, because deposits have actually declined for you for the first time in 16 quarters, while they're still up 16% year on year, down 0.3% quarter on quarter. That's the lowest in 6 quarters. How do you see this trend moving forward?
It's not unusual for deposits to drop off in the first quarter, because you normally end March on a pretty high. At least the way I look at it, you know, there's a lot of talk in India about, oh, everybody's going to the capital markets and therefore deposits are going to drain out. Frankly, I've worked in the US, I've worked in the UK, and deposits have pretty much stayed flat as a percentage of GDP and continued to grow all over the years, right? And there, obviously the participation in the capital markets is much, much, much higher than in India. So this notion that suddenly, you know, there's going to be a complete dearth of deposits and everybody's going to invest in the capital markets, I think it's overdone, right? And I think that, you know, look, as long as there's an economy, as long as there's expenditure, as long as there's businesses, deposits will continue to kind of grow. Is the customer becoming more sophisticated and savvy? Absolutely. And that's bound to happen, right? But I don't see this situation as suddenly deposits are going to suddenly disappear.
Interesting conversation, and you can catch the entire one tonight at 7:30 p.m. on CNBC TV18 with Ashok Vaswani, MD CEO of Kotak Mahindra Bank. Get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in, and she's got her eye on gold.
Welcome back. You're still tuned into Trading Hour. Well, the markets have taken some breather, but what's doing well and continues to do well is gold, definitely. So let's talk about the commodity space. Manisha is joining in now. We're focusing on gold today, Manisha. As they say, it's sona move for gold.
Well, yes. You know, it has been a great run-up for the gold prices for this year. And because we've seen a quarter go by, this actually has been the best quarter that the gold prices have put in. And this is in last 8 years. We did see an all-time high of $26.85 an ounce. ounce. And when you look at the kind of surge that the gold prices have seen, the rally began in 2023 in the month of October. That is when the gold prices were trading at 1800, and from that to almost 2700 is how we've seen the gold prices run up. If you look at this year itself, it has been on 37 days that the gold prices have hit an all-time high, which actually has been the highest ever in sense of its own records. The markets are looking at a longer-term bullishness continue in case of the gold prices. That is because the global debt and borrowing by governments is at a record of 315 trillion. The expectation also that you would be looking at further interest rate cuts coming in from the US Fed. There's a 55% probability that a 50 basis point rate cut is what you could be seeing in the month of November as well. That has been supportive. Also, China's additional stimulus measures leads to more liquidity into the markets, means more buying in gold. Broader escalation risks in the Middle East also have been adding to the premium here, and is the reason the latest UBS report now says that they will continue to be bullish in case of gold prices. They expect 2750 by the end of this year, and they've upped their target to 2900 by the third quarter of 2025. This is in line with various other reports from Citi and Bank of America as well, which have been talking about 2800 to 3000 of a possibility in 2025. So yet another very strong quarter, and this quarter now is about festival season buying, not just in India but the global markets as well, ahead of Christmas and holidays. So gold buying by the physical markets also is expected to be strong.
Thank you very much for that. There's no stopping this gold rush, is there, Manisha? We'll slip into a break. We'll come back and discuss the latest trends from the retail real estate sector. We'll invite Pushpa Bector from DLF Retail and Nishank Joshi from Nexus Select Trust. Stay tuned.
Welcome back. You're still tuned into Trading Hour. It's time to talk about the retail real estate sector. A recent report from Nuvama says they believe consumption is a long-term structural growth story in India, and India is emerging as a hotspot for global retailers. And of course, we have the festive season coming up as well, with Navratri starting from Thursday itself. To discuss this and more, Pushpa Bector, Senior Executive Director and Business Head at DLF Retail, and Nishank Joshi, Chief Marketing Officer at Nexus Select Trust, is joining us now. Pushpa and Nishank, thank you so much for joining us today. And, I wanted to understand how Q2 has been in terms of footfalls, and with the festive season coming up, entire October will be about festivals, some of November as well, and December. So what are the footfalls looking like going forward? Have you already started seeing some surge here? Nishank, let me start with you. Yeah.
All right. Okay. Because we are listed, we can only talk about Q1. So we ended Q1 at 8%, and we've got a positive trend since then. So the numbers, both of footfalls and sales, have improved since then. So we are on an upward trend. We ended with the Apple products going live, and therefore we've got a good numbers getting into the festive season. As we get into the festive seasons, we've got our decors in place, we've got our ideas in place, we've got our concepts in place. But more importantly, our campaign with Ayushmann Khurrana as a brand ambassador now breaks in the next couple of weeks. So we are good to go for a very strong festive season. You're right, it'll go from Dussehra to Diwali all the way to the end of season sale and Christmas. So it's going to be an awesome 3 months for us. I think it's looking very positive now. Sales and footfalls both have increased to an extent where I think retailers are very positive now. That's the feedback that we're getting. The stocks are all piled up, so we are good to go. Retail is good to go for the next 3 months.
Do you want to give us a broad range of the kind of growth we can expect in the coming festive season compared to, say, last year?
I can't give you that number right now.
Okay. All right. Ms. Pushpa, thank you very much for joining in. So, malls is a very nice consumption, to assess the consumption play in India, both in Tier 1 metro cities and in Tier 2. So first, if you could just tell us how the landscape has changed, for DLF retail. You all are present predominantly in the north, but how you've seen the landscape change in the last, 2 to 3 years, the way consumption is booming. And then if you could give us some picture on the near and now. What's the prep going into the festive season? What's the growth looking like, expectation?
Right. Good morning, everyone. So one thing I can tell you is that as far as the festive season is concerned, we are pretty bullish because we do think that, yes, we are predominantly present in the north, but north is also high consumption space, and it's always done well when it comes to festive season. We do think that, the trends first quarter was a little muted, but after that, the trends have been positive. And yes, we do think that it's going to be a good festive season, attributing to two things. One is we ourselves have set up many new brands in our portfolio. Almost around 80 new brands have been there. So that creates new interest. The other aspect is that it's a very long wedding season that we are seeing. That also has a good play on shopping in malls. So these two elements will definitely propel a higher shopping intensity in our properties. And we are starting a shopping festival starting the first season. And I'm sure we can all give.
Okay. Ms. Bector, I think there is some technical issue, so we'll just come back to you. Let me go across to Nishank. I just wanted to understand, is there a category of product which is seeing the most amount of demand? Does it change season-wise? Because at a point in time, we were talking about luxury goods doing really well. That was during COVID. Has that changed over years? What has the trend been like?
That's correct. It does keep on changing season to season. This time around, over the next 3 months, what you will see is electronics and gold being the focus. Fashion has been on the rise, but it's not picked up well enough, I would think. But we're really expecting gold and electronics to be the stars starting, say, somewhere around October. And then, of course, the wedding season kicks in, which is when the ethnic wear will start to come in. So these are the three big categories that I think are going to make a big difference over the next couple of months.
Can you tell us a little bit more about the entry of global brands in India? What are the numbers looking like? And is that going to be a big factor driving growth?
It will. So we've got the Apple flagship, which opened at Select City Walk, which great numbers. I mean, it was phenomenal. You had lines from 8 o'clock onwards. From 7 o'clock onwards over there. So it's done phenomenally well. We've got Foot Locker that will be opening now in the next couple of weeks. We've got a couple of more brands opening in Delhi itself, and then a few more across the portfolio. So, the market's really bullish, and I think the retail community at large is now looking at the next few months to really kickstart a really good festive season. I can't give you the numbers yet, obviously, but they are bullish, and I think the whole retail industry is looking forward to a really strong now Q3.
So, Nishank, tell us, what has the occupancy been like so far? Has there been any improvement, any new leases that you have entered into with retailers? And what's the pipeline? Because we are talking about the per capita consumption in India for malls being really low, and Nexus is primarily looking at that portfolio. What is the outlook going forward in terms of pipeline?
We are already around 95% plus, and our grade A malls are at 97% plus. So there are new leases being signed all the time, but we are already full. I mean, there's a list of people who are willing to walk into our malls, and we don't have space to give them. But the pipeline is strong, and we're already at 97%. So there's only that much play that we have. So.
So are you looking at expansion pan-India? What is the pipeline looking like there? Will it be by acquisitions? Will you be looking at ghost malls in in tier 3, tier 2 cities as well?
It's still a tier 2. It's still a tier 1 and tier 2 company. So we will continue to acquire there, and we've got a strong acquisition pipeline. In fact, we have signed around 3. Is it 3? Yeah. It is. Yeah. So we've signed around 3 LOIs, and so we are looking at a few of them coming.
So in the next, say, 3 years, Nishank, if you had to assess where Nexus will be in terms of size, in terms of the opportunity, do you want to lay out the big picture for us?
Nexus will continue to be the #1 operator over the next 5 years, is what I can say. I can't give you a number as to how big we will be. We are already at 10 million. I'm sorry, we have signed 5, not 3. So we already will be up to 23 malls by the end of 2025. 5 years, I don't know. I can't even give you a number.
Okay. All right, Nishank, we get that. Ms. Bector is back with us. We were talking about the wedding season doing really well, the festive season doing really well. I wanted to understand what kind of product portfolio is doing really well in your malls. Is it ultra luxury, luxury? And what about occupancy levels? Where have they been like in Q2? And is there an improvement expected or pipeline expansion expected?
Yes. So the occupancy levels have now in the range of around 96 to 97%. They will, whatever fit outs had to happen is concluding now. So at a portfolio level will be 96 to 97. As far as the, the overall outlook of categories is concerned, of course, Uber Luxury has done well, but I would also say that the wedding shopping is across the board, premium shopping, premium malls also do really well. Winter merchandise, this year, we anticipate a long winter in North, and hence the winter merchandise the off-tick should be pretty good. So overall, I would say the category would be on fashion and beauty, which is anticipated to do rather well. So is the case with jewelry.
Okay. I just wanted to understand, how often do rental uptakes take place? How often do you revise them? And so far, what has been the rental uptake that we've seen in the industry so far for DLF itself? And when is the next one due?
Well, that's an usual role of business. So every 3 years, there is a rental uptick. But, and this is something that this particular year, we saw a lot of leases coming to an end, which is why we had an opportunity to get in newer brands. And the rental uptick has been rather good. We are clocking around 25% on an average as compared to the last rental. So it's been bucking our own estimates.
Okay, 25% higher. That's interesting. A very interesting discussion. And of course, we'll get to know more trends once the silent period is over, and also when we start getting in trends coming in from the festive season sales as well. Thank you so much, Nishank and Pushpa, for joining in today with your take on what's expected and what's been happening in the mall industry. We'll slip into a short break. When we come, we'll discuss market technicals with Mitesh Thakkar and discuss the top trading bets.
Welcome back. It's 25,750 on the Nifty. We're down close to about 65 odd points, but individual stocks in the mid-cap space continue to zoom. Angel One is, one stock which is up nearly about 7-8%. There is an increase in transaction charges. Jayashree team, McLeod Russell continue to see buying. Z Media, a stock that Vamakshi was telling us yesterday, has now rallied 90% in the last 1 month. And Take Solutions too, on large volumes, is taking off for the third consecutive day. Pull up a 1-week chart of Take Solutions. But Mitesh is now with us for a quick technical check on the markets. Mitesh, afternoon slipped a little bit more, but again, not too much.
The only worry point for me is that we are below 25,800. I hope by the end of the day we can try and avoid that, and that should ensure that the immediate trend is not reversed, it's just a pullback. So we'll keep watching that. But on the stock side, I have a buy on Metropolis. That's a stock which is making a fresh high. So keep a stop below 2,200, maybe 2,195. Look for targets in excess of 2,300. And Memphis, I think that's a stock slightly turning negative. I would want to sell it if it breaks today's low, which is about 3,004. The stock is trading around 3,020 right now. So if it breaks 3,004, take a short position with a stop at 3040 and look for a target of 2920.
All right. Thank you so much, Mitesh, for joining us as always with your technical picks. With that, let's move on and talk about some stock-specific movement. NMDC, that stock is under pressure amid a likely surge in prices. Nigel is joining us to tell us more on what's happening here. Nigel.
Well, that's right. It was expected, and sources tell us here on CNBC TV18 that, in fact, NMDC has gone ahead and they've increased prices by 300 to 400 rupees per ton. That's effectively midnight. Now, keep in mind that from May till yesterday, the prices were down by around 1,000 to around 1,100 rupees per ton. So in that case, they're pulling back 30 to 40% of the price cuts that we saw earlier. The reason for this price hike is that global prices have gone through the roof. It's up close to around 25% from around $90 per ton all the way to around $110 per ton. So that's one factor. The second factor is seasonally, the second half of the year is a stronger period because steel production goes up. And if higher steel production comes about, then they need more amount of iron ore. So put that together, that's the reason why NMDC has high prices. Moving to Nalco. Now, Kotak has done a U-turn out there. They've changed their stance on the stock. They have upgraded the stock to add from sell earlier. They've also increased the target price to 235 from around 160 earlier. How does this come about? They've increased their EBITDA and EPS estimates for the next few years. That comes up for you on the screen. And also, they're giving it a higher multiple now. They're giving it a multiple of around 7 from around 5.5 times earlier. Let's highlight the 4 big factors that they are talking about. One is they've upgraded their estimates both on aluminium as well as on alumina. And on alumina, they're saying that the global situation itself is tight. So alumina could remain strong from here on. That's on the pricing aspect. On the cost aspect, they're saying they're getting captive coal from their mines in FY24, in FY25, and that's only going to increase from here on. So pricing, cost, and then what about volume growth? They're talking about from second half of FY27, the alumina refinery, the expanded capacity will come on stream, and that's what will help volume growth from year on as well. The project has been delayed, but now they're saying second half of FY27. So put all this together, Kotak has done a U-turn. Now they're positive on Nalco.
Thank you very much for that. Now moving on to Muthoot Finance, Manappuram Finance, Catholic Syrian Bank. These are all stocks under pressure. This is after the Reserve Bank of India has found several irregular practices being followed by the gold loan financiers. Abhishek joins in with the details on this. Abhishek.
Well, Rima, as you mentioned, RBI has found deficiencies in selected supervised entities with respect to gold financing. So comprehensive review has been advised for all and a 3-month time period have been given to them. So on review and on-site examination for selected supervisory entities, RBI has found that there is prudential guideline as well as practices which are actually, hurting the segment or which are being followed, unethically or illegally. So that is where RBI has pointed that there are several irregularity practices and major deficiencies which includes the likes of shortcoming in terms of use of third parties to source as well as appraise the loans, valuation of gold without the presence of the customer, and inadequate due diligence and lack of end use of monitoring of gold loans that's being given to customers. There is also lack of transparency during auctioning of golds. ornaments and jewelry on default of the customers. So when a customer becomes NPA, the lending institute do tend to auction the gold, and that is where there are various transparency which are not being given to RBI. Weakness in monitoring the LTV, which is loan to value, typically 65 to 75% is the range followed by gold financiers, and there is incorrect application of risk weight, etc. So we have a note from Citi which says that the highest amount of gold loans amongst banks are of Federal Bank at 12.2%, Bank of Baroda at 4.6%, RBL and SBI at around 3.5 to 3.8%. In terms of NBFCs, Muthoot Finance has the highest share with 82.5%, Manappuram at 52.6%, IIFL Finance at 21.2%, and SBFC at around 16%. Back to you.
Okay, all right. So that is about gold financiers. Thank you, Abhishek, for joining in with all those important details. Let's take a short break now. Up next, we'll discuss the market fundamentals with Madan Gopal Ramu of Sundaram Alternate Assets. Stay tuned for that. Welcome back. You're still tuned into Trading Hour on CNBC TV18. For the markets, the mid caps, they have improved substantially from the lows. The recovery is something that is leading to a 75-point gain on the mid caps right now. It is closer to the day's high. Bank Nifty too has recovered, so it's a 45-point gain that we're seeing on the Bank Nifty as well. Pull up a Godrej Properties because that stock is in focus. The company just reported to the exchanges a while back that they will be raising 6,000 crore rupees. That's the kind of fundraise they are planning, and it could be via any mode. It could be equities, debt, and other segments as well. So we'll watch out for more details on this one. Company has been on an expansion spree, and they have spoken about needing a bigger chest to do that expansion as well. In terms of sectors, we have the Nifty IT, which is doing very well. The small cap space is continuing to do well, so the mid caps are catching up to that. And we have stocks like Kotak Mahindra Bank at the day's high. There's M&M, SBI, some of these IT names like HCL Tech and Wipro also, which are leading to the gains that we are seeing on the Nifty, or the recovery that we are seeing on the Nifty currently from the lows. So it's a good time to get a fundamental check on the markets as well. Madan Gopal Ramu from Sundaram Alternate Assets joins us now to discuss market fundamentals and top sectoral bets as well. Mr. Ramu, good morning. Thank you so much for joining in. You say in your note that earnings is the biggest risk that the markets are looking at right now. Give us a sense of what are the earnings that you're expecting in FY25. Quarter one was weak, of course. We saw low single-digit growth in earnings across most of the sectors. What is the number for FY25?
Hi. I think we began the year with an expectation that the large caps will deliver a 15-16% sort of an earnings growth. Midway into it, we always believe that is going to be difficult. And in looking at what is happening in the major sectors in the Nifty, 10 to 12% growth looked possible. But end of Q1, we feel that there will be further compression in earnings growth. Probably in high single digit is where I think the Nifty is likely to end. We've also see a similar impact happening in mid and small cap. While the absolute growth might be higher than large caps, but compared to the expectations, even mid and small cap space are likely to disappoint. So this overall likely to put pressure on the valuation in certain segments of the market. And that's the view that we currently have on the earnings.
Hi, morning. This is Rima here. Wanted to get your thoughts in on these wealth managers, brokers. Now, they've had a phenomenal run. Stocks have doubled, tripled. But now the expectation is that, SEBI tightening the F&O regulations is coming. It could come very soon is what we've learned from our sources. And according to, so many notes that it could hurt earnings by 20, 25, 30%. Where do you stand on this entire, wealth management, brokerage kind of businesses? Do you think it's time to book profits?
I think the regulation-related impact is already priced in these stocks, in most of them. And with the recent rally that has happened in markets, I think generally in the first half, these stocks tend to underperform. In the second half, they pull back really strong, given the visibility that they have on the overall earnings growth that can happen for the full year. So that's what we probably might see in these stocks happening. This is more short term, but I agree with you that most of these stocks have given phenomenal rally in the last 2-3 years. These are high beta plays on the markets. When you turn negative on the markets, you cannot be holding these stocks. But I feel that Indian markets, particularly mid and small cap, continue to rally. And there could be some pullback on large caps with what is happening in China and all. We can discuss about it later. But I think we play in this one of the idea, which is exchange. Exchanges is a long-term opportunity. And I think the kind of profitability exchanges can throw in the long term and the kind of conversion they do on every incremental revenue in terms of margin, it looks pretty attractive as a business. And today there is only one listed exchange company. So that we are positive from a long-term perspective. While the other market players, you can play them as an I beta, as a play on the market, but that's more 1 year view. And you need to review your positions end of every 6 months to see whether you're on the right track.
Okay. Wanted to understand your take. There are sectors like energy transition, NBFCs, and consumer discretionary that you like. We got that update coming in on the RBI talking about gold financiers, some of the issues that they have there. What from the NBFC space do you like more? And the energy transition theme, there are a lot of facets to that. Which one is that you are bullish on?
Yeah, thank you. First, on NBFC side, I think we have always been bullish on NBFC from a structural play. Retail credit in India is still underpenetrated, and there is a long way to go. And there are sectors like affordable housing, used vehicle, and small ticket labs. These are areas where smaller NBFCs are growing, and they're doing a phenomenal job. There are 2-3 stocks that we are invested in. They are seeing a growth upwards of 30% plus. If you look at during COVID, their NPA numbers are also been very benign and very comfortable. And if you can select some of these companies and the founders who are running the show in a much stable manner and also playing this growth opportunity, I think there are a lot of money to be made in those areas. We are not generally very positive on gold as well as salaried housing loans within the NBFCs, primarily because these are areas where banks are very active. And when banks are very active, I think you are left with the most risky segment of the customers. And also your pricing ability is also pretty, it will be constrained given the competition from banks. So given these reasons, we have been not very active on the gold side as well as on the housing loan, particularly on the salaried side. But we like affordable housing, used vehicle, and small ticket lab, MSME lending, these kind of areas. Where I still feel banks are not very active, and it requires a lot of offline presence, which protects them from even the fintechs. So these are the spaces that we are interested in. On the energy transition space, it's a pretty interesting thing that is happening, not just in India, even globally. If you look at India, India's energy demand is growing, and simultaneously we want to meet our climate change targets as well. But always it has been unaffordable. And now, given the battery prices where they are, the lithium-ion battery prices where they are, and even the solar modules prices where they are, you can actually try to reach this climate targets and also meet energy demand at a very affordable level without any government subsidy. And this is definitely a structural trend. And given what the commentary from technology experts in globally, the prices are further likely to go down. So you can actually add a lot of these new energy technologies and be a large part of the energy mix in India. That's a story that can play over the next 5 to 10 years, I think. Within that, we like companies which are electric vehicle battery manufacturing, chemical manufacturing. We also like companies which are, see, one more thing that is happening is government is protecting the domestic manufacturing in these areas. If you let it open, I think Chinese can literally kill the space. But given the government protection for domestic manufacturing and these policies being consistent, there is a reasonable amount of money to be made in these areas. So we are positive on one, the solar being an active part of the power sector energy mix, and on the mobility side, electric vehicle penetration growing up in India in a significant manner. You can play them either on the either the developer in the power side or the OEMs in the auto side. But more so, we find value in the second leg, an auto anch which is more focused on the electric vehicle component supply. Also on the power side, equipment suppliers in this space. they look much more attractive, and they generally perform well in the early part of the cycle. So that's where our focus is.
You know, we were chatting with Bajaj Auto earlier, and he said that their green energy portfolio, which is EV, two-wheelers, three-wheelers, CNG, etc., now constitutes 40% of their domestic sales. So that's seen a big jump. Just a quick word. In the last conversation, you said that you added on a metal play. I think it was an aluminium play, which was a tactical move. Now, that's played out really well, given the stimulus from China, the rally that we've seen in metal stock. So running out of time, what happens to that tactical play on, a company like, say, Hindalco? Do you ride it, or it's time to book profits?
No, I think there is one more leg to play here. I think given what is happening in China, if you are going to be a large cap player in India, you will be worried about the recent performers, particularly the defensive sectors like FMCG and healthcare, where you will move the money. You will have to move the money where the beneficiaries from China's uptick that can happen. So metals likely to be a favorable position there. So that's something can have one more leg of move is what we feel.
Okay, all right. So that will be an interesting theme to watch out for. Thank you so much for joining in today with all your thoughts and the outlook on the markets as well. Before we move on, let's talk about some good news for our viewers. India's business news leader is now click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store.
Welcome back. Markets very quiet, but one of the big developments over the last 24 hours was that SEBI board meeting which took place, and the press release was only announced much later in the night. We were all waiting for what comes out. Shivani is now joining you with some more details and the key highlights. Shivani.
Well, yes, a slew of measures were announced late last evening by the market regulator after the board meeting. Many of these announcements were expected as well. SEBI announced that the stockbrokers must implement a UPI block mechanism or 3-in-1 trading by February 2025. Another important thing for the market is that the regulator has expanded the T+0 settlement cycle to the top 500 market cap stocks. Another important thing that was expected is that SEBI has announced a faster process for rights issues, now completing within 23 working days. Promoters can renounce their rights to specific investors, enhancing flexibility. One of the things that everyone was watching out for, SEBI has also launched a new asset class bridging the gap between mutual funds and portfolio management services, the PMS, aimed at tackling unregistered schemes and providing investors with flexible regulated options. The minimum investment is set at 10 lakh rupees, and the safeguards include no leverage and capped derivative exposure. On the mutual fund side, the new MF Lite framework has also been announced. The new norms ease compliance for passive funds, allowing asset managers to opt for relaxed regulations or hive off passive schemes. The regulator has expanded the definition of connected persons under the insider trading regulations as well, now including firms and individuals sharing households with connected persons that were defined earlier. This is one of the things that is seeing mixed reactions from the experts. Interestingly, no announcements on as expected on the F&O segment as of now. Back to you.
Shivani, thank you so much for joining in with all those important details. By the way, substantial recovery on Nifty from the lows. It is in the green right now, and Bank Nifty is the one which is supporting, and support coming in from IT as well. So we'll keep tracking market moves for you. For now, it's a wrap on Trading Hours. Stay tuned. Halftime report will come up next.